and good morning everyone. So I'm Siddharth, and the first session we are actually going to break it down between two key topics. One is the asset allocation, and second is how can we use special situations to improve our alpha. After that we will have our tea break, and then we move on to using options, and which is a very wide field in itself, and we will try to do as much as we can in that hour. Okay. So now to start with asset allocation. So this is a standard disclaimer. We are not a SEBI registered investment advisor or analyst, and this is a stock disclaimer. There could be stocks that we discuss about during our course of our presentations during the day where we may or may not have a position. So please be aware of that, and we do not, give any investment advice or not solicit any business related to that. Whatever we are going to speak about is as a practitioner, and we do it primarily for ourselves as our own family money. Okay. So now when we think about investments, if we think about how do we go about investments and what are the key questions that we face, I think when taking an investment decisions, the two broad questions that we have is, what are the fundamentals of a business? It could be if it is an equity, whether it's a good business, a growing business, is it a blue chip business, or if it is in real estate, whether it is a commercial building in a prime area. Basically, what are the fundamentals of the business? And the second key question is, what is the valuation? How much are we going to pay up for it? And collectively between the answers of the two questions, we can decide whether we want to go ahead with a investment or not. But in my opinion, there is a third question also which needs very careful attention, consideration, which we may not do it, give it the adequate attention. And that is, what is the investment environment we are in, and how do we strategically position our portfolios to benefit from the environment we are in. And in my humble opinion, this answer to this question, which is essentially an asset allocation decision, that how do we position our portfolio across assets to benefit from what we are witnessing in the environment around us, is a much larger determinant of how our net worth will grow over time. A particular stock can do well or not do so well, a particular investments can do well or not do so well. But allocation to answer to this question is very important in determining how our net worth evolves over time. So what exactly is asset allocation? So asset allocation is simply implementation of an investment strategy across various assets which may have uncorrelated returns, or across different risk profiles depending on an investor's his own risk objectives, his return objectives, his goals in life, and depending on that he can decide his allocation to various assets. And the assets could simply be equity, debt, commodities, gold, even cash. Cash could be an asset, real estate. So these are some of the assets that we can have. But why is asset allocation so important? So asset allocation essentially believes that different asset classes have returns that are not correlated with each other. And because of this, by allocating our investments in a portfolio to different assets, we can have better risk adjusted returns. That is, we can have lower variance or lower drawdown in our portfolio, which is meaningful for an individual investor. And we have a lot of academic studies which support this. There was a seminal paper in 1986, which determinants of portfolio performance, which clearly pointed out that asset allocation is the primary determinant of a portfolio's return variability. Not the return, but the variance in the return. So it depends on how much did you allocate to equity versus debt, which will determine how much do their return vary in a portfolio over a period of time, rather than one particular investment itself, right? So if you look at so this is an interesting chart. So if we look about here, this is borrowed from Howard Marks' newsletter, who is a very well-renowned hedge fund manager at Oaktree Capital. And what this chart shows us, if we see here, so on the x-axis, we have risk, and on the y-axis, we have returns. And as we move from left to right, we see there is a line which is sloping upwards, which is connecting the mean of the various 4 distributions. So what is this actually trying to show us here? If we try to understand this a little bit better, so at any given point, say point A, so this is a point, this is of the 4 assets, this is an asset with a relatively least risk. And if you see the range of returns possible, it is quite narrow. The range is just from here to here, which is a small range, and the mean expected return is this, which is the lowest among the 4. So what is it showing? That at any given point, as we move around the risk spectrum, a range of outcomes continue to widen. The expected return, that is the mean of the return, increases. But what an investor eventually realizes is not an expected return. It can be anywhere on this distribution, right? If you invest, say, in this security, the return that you finally realize could be anywhere on this spectrum. You could get the mean return, you could get a much lower return or a much higher return. So the variance is much higher, right? So for an investor, now this is theory is all right, but what does this say? So as an investor, when we are taking an asset allocation decision, so where are we going to allocate our money to asset, the least risk or the highest risk? So if I decide to allocate, the challenge that we have is, say, if we allocate to the rightmost asset, which has the highest expected return, but and we may end up with a bad event and actually achieve a very low return or a negative return. That is a possibility, right? So that is a key risk. At the same time, it is also a risk that the investor focuses on choosing the first asset, which has the lowest risk, but the risk there is that he actually realizes a very small return, which is also something which we don't want in the long run. So we can all be very safe and put all our money in FD. There is no variance in returns there, but the risk is that you would hardly meet inflation, right? You will achieve a very small positive return, or in fact, a negative real return, right? So what should we as practitioners do? Theoretically, we understand the concept that different assets have different risk profiles, but as practitioners, what could we do? So our goal should be to look for mispriced bets. The future is uncertain, right? We don't know. So no one knows what is going to happen. And in fact, John Kenneth very clearly, very succinctly pointed out that we have 2 classes of forecasters. Those who don't know and those who don't know that they don't know, right? So we don't really know what is going to happen, whether we accept it or not. Future is uncertain and a range of outcomes are possible, and our goal should be to look at mispriced bets. But what exactly is risk? If we look at our academic literature, when we look at our theoretical books, we talk about risk as the variance in returns. What is the standard deviation if you create a return series? How volatile the returns are, that is risk. That is an academic definition. But when we as a practitioners look at risk, for an investor, what is the risk? He is not really concerned, at least a lot of investors that we talk to are not really concerned about the variance in returns until it is crosses a certain threshold. What are they more concerned about is permanent loss of capital. I don't care if the stock that I invest in falls 10-15%, as long as I don't permanently lose that capital, right? So that is a key risk for us. Generally, it is perceived an asset which declines in prices is risky. And similarly, an asset which increases in prices is looked very favorably. And everyone wants to invest there. But practically, if you take a step back and think about it, a good asset which has declined in prices may actually be a very good investment now. It is not, the risk has actually reduced. If we, in a base case scenario, if the asset holds its value and the valuation has decreased, then the risk has reduced, not increased. But theoretically, psychologically, one would think of an asset with falling prices is more risky, and the one with increasing prices is more lucrative or lesser riskier to invest. And this is something which we saw last year in the US tech sector, for instance. As the FANG shares were going up, everyone thought nothing could go wrong in there. As the prices went up, people thought they are blue chip, they are very safe company to invest in, Amazons and Facebooks and Microsoft, nothing could go wrong there. But now, as the stock prices have started falling, today when Facebook is at like 200 billion market cap, at with 10x the cash flows, people only see the risk, that this could go to zero. So it is, This is something that we need to be careful about. And one more risk that an investment practitioner needs to think about is ability to stick through his investment plan through the cycle. What does that mean? Say, suppose I take an asset allocation decision that I would want to be, say, 60-70% invested in equity and 30% into debt. But then a drawdown phase comes into the market because of the market cycle, and our equity portfolio falls by certain, the drawdown is larger than what we anticipated. We did not thought it through as carefully, or we did not anticipate our ability to see those drawdowns. And we abandon that in its worst possible time and realize those losses. And we say, equity is not for me and I would rather stay in debt. So that is a key risk, because if you abandon your investment, well thought out investment plan during bad phases, then you realize permanent loss of capital. And that is something that we need to be very sure of as a practitioner, that we think through about what our risk tolerance are, what kind of drawdowns we are applicable to, and think through every assets, because most assets are cyclical. And so let us go through cycle of the asset. What does that mean? Assets are cyclical, and what does this really mean? And most assets are cyclical. We are just going to quickly touch on equity asset, because that is one of the key assets where a lot of investors want to invest in, and similar analysis could be done for any assets. So here what we see is an equity market, the y-axis is the return and the x-axis is the time. Over a time, you would expect the returns to keep on increasing. But actually, in reality, what happens is there are times where you have accelerated returns, much more than what you would anticipate, because a lot of returns are front-loaded, which when it sharply goes above the median curve. And then there are periods, long periods, where you have negative or no returns, where when this again goes down below the mean. So this cycle creates an opportunity. But why does this cycle occur in the markets? It's a combination of, for equity markets, combination of various factors which can broadly be classified into two things. One is the economic business cycle, and the other is the investor behavior cycle, and the two coincide together to create large volatility in equity. So if you look at economic cycle, I'm not an economist, and I think these are some very basic concepts a lot of us are very comfortable and familiar with. An economy does not grow steadily, because if you look at GDP and time, what is actually GDP? GDP is just the product of your working population growth and the productivity of labor. Either of them does not change drastically over a short period of time, the population or the productivity. So you would expect the GDP to linearly increase over time as the population slightly grows, and the productivity also keeps on improving over time. But practically, in reality, what we see is that there are cycles in economy as well. There are expansionary phase followed by peak and the recession and trough. And a lot of this is because in expansionary phase, there's a lot of demand for goods and services. Businesses go into expanding. Cheap credit is available, which funds both consumption and business expansion. And and it's such a huge demand for assets and goods creates inflationary environment, and which finally the regulators wants to control, because they don't want the economy to get too overheated, and the interest rate starts to rise. And the rising of the interest rates now in a way makes it difficult to borrow capital both for consumption and business expansion, which leads to reduction in demand, and slowly it tends to slow down. So US economy is a very clear recent example to that. In the last 2 years, we saw when the government was giving these handouts to people, there was so much liquidity available in the market, which led to a great demand for goods and services. All the asset prices went up. All the goods, whether it is cars, real estate, travel, hotels, all the prices were going up. There was such a great demand for all the products that they could not be supplied even. There was shortage of everything. There was such a great demand. And this led to inflationary conditions, as you would have seen. All the commodities, steel, copper, everything went up so drastically. Finally, the government decided to cool down the inflation and has started raising rates. And now you have seen all the rates again have started to come down. And the job market, which was so hot, that you would have heard in India also that people in IT were switching jobs at 2x, 3x salaries. Now in US, we are already hearing about mass layoffs, even in the blue chip or the largest tech companies. So the environment has totally changed. So, from an expansionary phase, we went to a peak and it is already downhill towards recession. And somewhere along the line, we will trough and the government policies and the actions would again lead to an expansion. These are the usual cycles, right? And how does investor behave during these cycles? So, economic cycle also creates a greater demands not only for consumption goods but also for investment goods. When we do as an investor, we in an expansionary phase, we invest in an asset and the asset starts appreciating, we feel excited. We want to do it more. And as the appreciation increases, as we are going up, we are thrilled and we want to participate in newer and newer issues wherever, this is the phase where people would also want to take more leverage, go overboard the allocations, abandon their well thought of allocation policies the debt allocations seems like a cost. My equity allocation is up 80%. I'm hardly making anything in debt. Why should I be invested in debt? Let's take that money out and put it into equity. The opportunity cost seems way too high to be invested in equity at this moment, to be invested in debt at this moment. And this leads to a peak euphoria. Finally, all the assets are cyclical. They will not go to the moon. And peak euphoria there are clear signs that you could see in the market. If you look at the top performing companies, a lot of shady companies would come up. There would be a lot of small companies with questionable management and businesses which are coming up with IPOs at inflated price. And there will be an immense demand for it. If people want to overextend themselves in investments. And as this phase slowly turns, the smart people would gradually start selling their investments while the newcomers who are excited by the recent gains are taking on more and more leverage to invest. But as we cross over the peak, we see the first signs of drawdowns, now the first time investors or the new investor starts getting anxious because this is a phase they have not seen. They have only seen rising markets till now. It starts with an anxiety. Then there's a denial. There seems to deny what is happening to them. They are in a disbelief. It leads to fear. At times they are afraid because they have lost a large part of their gain and they are fearful that what could happen to their investments. As it continues to fall further, there is desperation, and finally there is panic and capitulation. What does capitulation means? That the pain of the falling prices becomes so much that they don't care about the valuation at all. They just want their way out. They say equity is not for me. I'll sell, give me my money back, whatever is left, I'll put into debt and I will be at peace. I don't want equity at all. So once again, they are abandoning their asset allocation decisions. Because of this is just a cycle, but in that point of the cycle, they sell all their equity, they get into cash, and that in a way creates the bottom. Because whoever wants to sell all the hot money, they have now exited the market, and people who are really long-term, who have been patient, they buy it from them. And now as there is no more selling pressure left into the market, all the leverage, the excesses that were built in, they have been cleared now. So we see a gradual recovery again to the expansionary side. So this is, and the two combined, business cycle and the investor behavior cycle creates these cycles. But how do we all understand these things, but how can we actually use them, right? For practically, how can we use them? So this is again taken from Howard Marks' book, Mastering the Cycle. This is a very good book which he has written. I recommend you all guys to read it. By Howard Mark, where he talks about various cycles in the market and what has been practically observed in various economies and how can one use them to take their decisions. So what we see is that on the chart on the left, so over a market cycle, the returns are expected around this, and this is the mean return over a period of time, and the actual return oscillates around that. So when something is at a mean return value, what is the expected return payoff? If we look at over here, so expected return payoff is normally distributed, but with an expected outcome which is positive, greater than 0. Let me try to go a bit slower here. Again, try to explain this. The returns, when the valuations are at their average mean, you would expect the future returns. We don't know for certain what the return would be. It could be a range of outcome. But when you are buying at mean or reasonable valuations, you would expect equity to give a positive return. The expected return is positive. You can still end up with a negative return, or you can end up with a very high positive return, but the mean case or the base case for you to have a positive return. right? Which is what, otherwise why would one invest in equity if the base case is not even positive, right? So this is what essentially happens. But when we invest in different phases of the cycle, say when we are investing at very high valuations, when the cycle is at its peak, the expected returns, future expected returns gets negatively skewed. Then now the base case is your negative. Rather than making a positive return, the base case is your range of distribution is shifted towards the left. You can actually, it is difficult to even break even. The odds are not in your favor. You may still end up with a positive return, but the odds are not favorable anymore. And similarly, when we invest at the bottom of the cycle, the odds are vehemently in your favor. It is very difficult, it's very difficult to make a loss. And it is vehemently in your favor. And this is the time we need to be aggressive in our investments. Right? So depending on where we are in our valuation cycle, it can help us decide on our asset allocation. When the odds are in our favor, we should be aggressive in our investments, and when they are not, we should be more defensive. Now, this is all theory. I mean, we understand the theoretical concept, but as practitioners, let's look at some of the data, what has actually happened in the market, and see if this theory also coincides with practically what has happened. So the first set of data that we are going to look at is Nifty valuations versus Nifty, how the Nifty has performed. So what I have done is I have Nifty price to book value. Rather than PE ratio, I have tried to use the book value as a price to book value ratio as a valuation metric, because book value is more tangible and it is lesser prone to change by a small events which happen over a small period of time. Because for instance, during COVID times, your earnings fell drastically, but the book value would still stay in a range. They will not fall as rapidly for a small horizon. So book value tends to be more stable. So, and their multiples to that give us a good idea of how the general valuations are. So I took price to book value ratios for the last 20 years, and we have them in various percentiles. So if those price to book value, we plotted them over time depending on their percentile. So this one is the price to book value, and this is the Nifty chart. We can clearly see when the price to book valuation peaked here, then the returns over the next future were negative or downhill. And similarly, when they bottomed, the future returns were positive. Again, when it peaked, the future returns were negative, and when the valuations again were favorable, if you invest there, the future returns are positive. The cycle has been going on and on, right? Similarly, there is another set of data which we can look at. This is BSE small cap versus Nifty. BSE small cap is the smallest companies which are there in India, listed in India. This index includes roughly around 500-600 companies. These are the smallest companies which are not part of any other index. So a large part of individual investors as practitioners tend to invest in small companies, and this index is a fairly good representative of how that portfolio would do over time. And so what we have here is the ratio of small cap index versus Nifty and the returns of the small cap index over time. And the cyclicality is clearly evident. The above line is the ratio, and the below line is your performance of the small cap index. So when the ratio is very high, the future returns are negative, and when it bottoms out, the future returns are very positive. And just using this insight itself, if one decides on asset allocation, it could make a meaningful difference into the returns. Let's see how. So this is some of the allocation alpha that we have calculated. So what we had, first we talk about Nifty versus the price value, the first chart that we saw. So we have done this since April 2009 when the market bottomed. Since then, the Nifty returns have been 5.5x. If we have invested in April 2009 till now, the Nifty would have returned 5.5x. And if we invested in a debt portfolio, which was just debt instruments, at 8% return, it would have given us 2.93x over the last 12-13 years. But what if, as a conservative investor, we decide that we will not act till the ranges, the valuation ranges goes to an extreme. So we will say that when valuations are say above 90 percentile, the odds are not in my favor. I should be more defensive now. There's no point having aggressive investments, allocations to equity when the valuations are historically above the 90th percentile. I'll move to debt and I'll stay in debt till the odds are back in my favor, where the mean valuations are below 60th percentile. I'll switch back to equity. Till then, I'll stay in debt and conserve my money. Just doing this is a simple enough exercise to do. It does not require a lot of switches. When the valuations are very high, you exit the equity investments, go into debt, and when they become reasonable again, you go back into equity investments. And just doing this simple exercise, your returns would be 7.5x. It is an improvement over equity, but over maybe not meaningful enough for some investors, right? Yeah, it's almost 50% more than what you could have gone by 5.5x versus 7.5x, but still not as lucrative. But when now we come to this small cap versus large cap, this is where a lot of investors like us participate in. So Nifty gave 5.5x returns. Just being passively invested in a small cap index, it is not possible to invest in this. This investors index is not investable, but assumingly someone just invested in small cap companies, he would have got 8.5x returns, which is still improvement over Nifty. But again, using the same logic, when the valuation, the Nifty and small cap ratio crossed 80th percentile, if you switched back from small cap to Nifty, and when it fell below 20th percentile, you went aggressively into small caps, your portfolio return would have been 13.2x. It's very simple to do. In the last 13-year period, you have to do switches only 5 times. It's not that you are trading in and out very frequently. 5.5 times, acting 5 times in a 13-year period is not a lot of activity. And it is very simple enough to do. And the returns difference is, I think, very incredible for a passive investor. This does not require you to do any active investments, active monitoring any book, but you can make a sizable difference in your actual return realization. So this is what the theory shows us, right? I mean, just applying a little bit of knowledge, being a little bit more aware about how the investment environment is, how the valuations are, and tilting our, taking decisive actions at the extremes can significantly improve our returns. And increased in returns is just one of the benefit. The other benefit that we as a full-time investor feel, and something maybe which is not very difficult to capture in theory and can only be felt by a practitioner, by doing these switches, you feel psychologically a lot more comfortable during drawdown phases when the market is correcting, which it eventually will. So you feel more in control of things, and you are in a much more positive frame of mind to solicit and look at investment opportunities rather than worrying about the drawdowns that your portfolio is having. It puts you in a very constructive mind frame to be able to analyze that investment opportunities rather than being a worrier, what I am having so much of losses. That itself has its own value, right? You're not having to worry about the drawdowns that you are going to face. So now I think Gaurav will talk about,
These two charts suggest where are we on the curve of the economic cycle, because you are suggesting it where these are latest numbers
so,
to the 100% percentile.
No, the Nifty versus price by book value, it is currently around 70th percentile. So I would not, the valuations are not as extreme at the moment. I think if you look at long-term mean averages, they're still reasonable. They're slightly elevated, but at least the data doesn't tell us they are as alarming to sell everything and get into debt. So I would stay invested in, if I was following that, I'll stay invested in large cap equity, not move to debt at the moment. If I was investing in small cap, so it is closer to the top decile, and I think the percentile currently is around 75, 76. So this is a time where I would be very careful if I was largely invested into small caps. And anecdotally, you could also see if you bring out a list of top performing stocks, the highest gainers, you would invariably see a lot of SME companies which will come at the top. And you again see a lot of these SME IPOs which are coming and getting hugely oversubscribed. They are all telling you how the risk appetite is at the moment. So if I have to choose an allocation decisions now, I would be more biased. And practically what I am doing is I have been selling smaller companies and moving to more stable incomes. This is not a time where I'll make aggressive investments into the small cap space, because odds are not as much in my favor to do a new small cap investment at the moment.
Do you feel we are at a peak or closer to peak again?
So range of future is uncertain. The odds tell us, at least in terms of valuation, we are better off being cautious rather than very aggressive at the moment.
I mean, I'm just trying to take on this very clearly so that, you know, if we're talking to clients, forget small caps, if we are talking about Nifty, how much upside do you see? Because you're not getting out of equity at all. Assuming it goes back to 100%, that is the range, maybe till next budget you are into this. Are you looking at another 10% jump in large caps?
So this is not how we think about allocation decisions. So to take very short-term calls, ki how a asset class such as equity can do over the next 3-month period is not something that, you know, we even think about or have any ability to forecast or answer. We can't say, you know, and 10% is too small a number to say ki, you know, whether equity could go up 10% and next month also, right? Or it can fall 10% also, either case, right? So I would not think in those terms. What I would think in terms is, if I am a large cap investor, overall on an average basis, the market is not as expensive. Its 70th percentile is not an extreme valuation that I should get very worried about. There would always be things which are, you know, you can always pick up data points which point to things going negative. But that is the nature of the markets. And we, as an investor, we have to be optimistic. That is the first rule to make money. If you are not optimistic about future, that the future would be better than what it is today, it is difficult to make money into the equity markets.
How do these data points hold up when it comes to global indexes?
So these data points are just few of the data points that we have used, and these are not the only allocation decisions that we can use. Say if we have used valuation metric, if one wants, one can also use momentum as a way to allocate between the two asset classes, 2 or 3 asset classes. There is an entire field of literature around this, dual momentum, where you compare the relative performances of the various assets and take allocation depending on the allocation decisions, depending on the performance rather than the valuation. So these things.
I have a question. So I've done this exercise myself as well, and one thing I wanted to ask was switching entirely from equity to debt at 90 percentile, and then entirely moving from
Debt to equity.
Debt to equity at 60 percentile. In between, there's no movement.
No movement, because otherwise you will be incurring a lot of transaction costs and taxes, and it does not serve any purpose.
And the second question was on taxes. In fact, so when you are at this high level, so the difficult thing to convince investors is to sell because of taxes. There's a very high tax liability which comes at that point in time.
Right.
Because of the gains, obviously.
Right.
So I think so that will not be calculated in this. Right?
Correct. We have not considered the impact of taxes. So equity investments used to be tax-free in India. They are no longer so. So, and these are not really, you are making very frequent to and fro call. That is why I say that we have to take decisions only in extreme situations. When I say extreme, so when the return distribution is actually, if you go a slide back, we saw that, you know, when the valuations are extreme, the expected payoff is negative. So if the base case or the expected payoff or return is negative as a base case, would you rather stay invested to save taxes or conserve your capital and, you know, maybe, and as they also say, you know, every bull market has their, or every, you know, recovery has their own set of leaders. You may also want to reposition your portfolio into what's new is happening into the market. Yeah.
So I have 2 questions. So are you suggesting any numerical benchmark to make these changes? And second question is, you were suggesting 100% movement.
So I am telling you, if someone did this was possible. So I do not comment on what an individual should do. So for an individual, an asset allocation decision has to be a function of his own risk tolerance, right? So if I am comfortable with 100% allocation to equity, which you may not be, or one may not be, right? Someone would want to have a large allocation to real estate or gold. So depending on his own, asset allocation framework, what he has decided to, he has to think in terms of allocation. And this is just an example to show that taking decisive actions at extremes helps you in improving your return alpha, as compared to not acting at all. You don't need to take these decisions every other day, but once in a while, when you clearly see that the valuations have gone out of ranges, it is prudent to act on it, and they will help you improve your portfolio alpha, and they will also help you be in a much better place psychologically to invest, right? And whatever the asset classes are and at what percentile that you decide, it is also a function of how much drawdown you are ready to accept. And it could be different for different people. There are people who don't want to see any losses, and there are people who are also happy you can take a 40-50% drawdown in stride. So depending on what kind of person you are. So remember, as I said, the key risk is that you should not abandon your well thought out plan during a drawdown phase. If you do that, then you would have a permanent loss of capital.
So the question around percentiles, right? So when you were looking at the data in 2009, the percentiles in practice that you would have would be based on the 10 or 15 years preceding.
Yes.
So the percentiles, are they on that, or are they the percentiles for the period from 2009 till now?
So for our allocation decisions, the percentile that we have used is 5-year rolling percentile. So because the valuation regimes of the market would also change over time, the structure of the index or the quality of companies and the accounting policies, all those things are evolving. We thought that 5-year history is a reasonable history to get some sense of how
these backtests assume percentiles based on historical data.
Historical.
Not for the entire period.
Yes, historical 5 years rolling.
It's not like 2009 to 2022 की range को लेके नहीं.
Correct, नहीं. Last 5-year rolling data to take the allocation decision.
So, contrary to what you said on the comfort, see, if we go back and look at data between 2006 and 2009, see, you were above 90% percentile quarter, and which means that, ideally I should have sold all my equity and be in a comfortable position.
Correct.
Because the risk is less. But, the markets are going up.
Right.
So on one side, we are trying to, work on our behavior by saying that, if you are sitting on debt, then you will be comfortable, but markets are moving up. Markets
Correct.
probably moved up by
Right.
60-70%.
Right.
In fact, on the contrary, I will be more, inclined to get into that FOMO mode and may do some stupid decision, may buy real estate, may get back into equity, may try and recover my, opportunity loss which I have done. So theoretically, yes, I am in comfortable position, but practically, I'll be more, if I'm holding on to equity, probably I'm saner as compared to if I sell my equity off.
See, when you are at 2006 and when you are seeing very high valuations, at that time you don't know what the future returns would be, right? All you can go is what is the base case telling me, right? So it is like here you are at this point, right? It's not that if you invest at this point, your return will come only here. You can make this return also, right? Positive return also. This happened in 2006. What actually realized was something from here.
No, I'm not debating that at all. I am saying what you are saying theoretically is correct. I am talking on the behavioral part, because you are saying that if you do this, you'll be more comfortable. I am saying if I do this, even then the chances are very high that I'll be very uncomfortable. Maybe more uncomfortable than, as compared to if I was invested.
Correct.
So that is where my disconnect.
So if you feel, see, different people have different temperament. This is again one of the reasons that creates cycles, right? During the investor behavior is different. So if you feel that by nature you are a person who would feel FOMO, or who would feel being left out, and who will feel that having sold at what you think was high valuation, and you would be unhappy people making more money, because insanity, there's as people said, there's irrationality could last longer than sanity, right? So then probably you should not do it, and there are other ways to handle it, right? So I think trading people, if you are a person of that nature, maybe you decide on an allocation decision that you are not trying to sell it at that point, but have some sort of way to exit that, if the valuation or you are cognizant of the fact that the valuations are very high and you want an exit, and you are not selling only because because of the momentum, whatever there is in the markets are still going up, but you then are careful, and when the market starts to turn, when we saw the investment cycle, and when you see an anxiety and fear, at least you get out somewhere over there. You don't wait till the bottom of 2008, maybe sometime in 2007, you take some drawdown and get out of the market.
Let's assume I'm not a trader. Let's assume I don't understand all this.
So can we do the questions later, because there's a lot to cover. And
We will connect over in the break, right? So this was a lot of theoretical concept, but now our approach, how do we practically do it? This was a lot of data, but as a practitioner, what do we really do? So Gaurav is going to talk a little bit about it.
So, thanks, Siddharth. So I'll talk a bit about our approach as to what we do as asset allocation. One of the fundamental difference in our case is we don't think of assets as trying to diversify into real estate or cash or debt. In our case, we are only thinking in terms of two assets. So one asset is equity, which is you tend to go long in equity whenever you have the time. The other asset in our case is what we call the special situations and the option portfolio. So we'll talk a bit more about what exactly we do in those portfolios. That's subsequent part of the presentations. But what we here are trying to highlight is between the equity and the income portfolio. We call our options and the special situations portfolio as income portfolio because we are fairly convinced that even on a monthly basis or a quarterly basis, we will have positive returns on those portfolios. And so we think them as a proxy to income in our case. As Siddharth pointed out, we did a bit of modeling around had we followed those portfolios and for the last 20 years to model it out, and using price to book value as a benchmark to get the percentiles, and do the allocations according to these logics. So if the percentile is below 10, we are heavy in equity, which is 90%. So between 10 and 30, it's 80%. 30 and 70, it's 70% in equity. 70 to 90 is 50-50. And above 90, we've then moved to, we become invested in the income portfolio at 70%. So that's the basic model. And there's no correct way. This is just one of the approaches that we wanted to highlight. So the assumptions being, this data is for about 20 years, slightly more than 20 years, till 18th October. We are taking 1st Jan 2002 as a starting point because equity options started trading in India just from July 2001. And we are saying that the special situations and the option portfolio generates a 18% post-tax return, which we historically have been able to do better than that, but that's the benchmark that we wanted to work out. And given we are modeling it, so transaction cost is not something that we have factored in, but let's assume that gets factored into the returns. So on a 20-year basis, the absolute returns are for Nifty is 16.57. For the model portfolio, it's 42x. Annualized returns are 14.5% and 19.7%. Drawdown from the peak. And now this is another important aspect is because of the meltdown of 2008, the drawdown here was 59%, but on a combined portfolio basis, this drawdown was only 23%. And this is something that has played a lot while constructing this construct, because I got hit very hard during the 2008 meltdown, and because of that, I always wanted to build a construct where the drawdowns can be reduced. And over a period of time, that has evolved, the practice has evolved. And I've been trying to practice it since 2009, and Siddharth, once we were together from 2015 onwards, we have tried to further evolve and model it down. So the other factor is which, once we started option trading, there's a ratio called Kalmar ratio, which is the annualized returns divided by the peak drawdown for the year. We're not calling this Kalmar ratio because so it's for every year. But if you look at the annual returns versus the peak drawdown, the difference between the two approaches is pretty stark. So besides the annualized returns that are there, which we get an extra delta about, it's the drawdown that we can greatly reduce, which ultimately gets you into a very good framework of mind. Now, one can have many questions around it, that individual portfolios can do a lot better than Nifty. The taxation angles as you transact from one to another, there's always the tax incidence. But, and we haven't really modeled that in this aspect. But even granting for that, we think more than anything else, it puts you in a good frame of mind to start evaluating opportunities when the chips are down. So if you are, if you have allocated 50% of your investable net worth into a portfolio where you are pretty sure that you won't have a negative year, then once the meltdown happens, it's very easy for you to allocate money from that portfolio into beaten down shares and try to catch multi-baggers from there on. So yeah, so that's largely. So these are the literature that we have referred to in between. There's Howard Marks, the book. This is really good. The other thing that has played is David Swinson. He was a chief investment officer for Yale Foundation. He recently passed away. So this is again. So one of his basic tenets, which he proves a lot in his books, is that the returns of a portfolio are more determined by the asset classes they are allocated in rather than the individual picks in those asset classes. So what's going to determine your overall portfolio return is how much money you had in equity in, say, 2002 or 2003 or 2020, rather than saying, I picked this stock or this stock within that allocation. So the other is Morgan Housel. He talks a lot about psychology and how the human behavior is impacted by it. It's light reading, and I would recommend strongly that everybody should go through this book. He's an amazing writer, otherwise. So that kind of covers this session. So any specific questions of the last two slides that we talked about?
Can you talk a bit more about what kind of options do you sell or buy? I am assuming you sell.
So we have a 1 hour session on the options, but we'll subsequently delve into that. So
just a couple of questions on your working.
Sure.
When you're doing this exercise, you're working on daily valuation data, so your decision making is happening on daily basis?
Yeah, so it's a daily review depending on the percentile. So the decision points are at the extremes only. So either once we are crossing the 70-30, it does. So the surprising part was between 2014 to right up to 2020, there were no switchovers because it was right in that middle of the range. If we go back to that graph, the previous one, yeah. So if you go back to this particular period, during this there were no switchover decisions because the market was pretty middling during this period. And we like to think we modeled it with price to equity, and so equity earnings they vary a lot, and that dramatically increases your decision points. So I think price to book value is a much more stable metric to work with.
Sure. And when you're working with daily data, are you trying to smoothen out anything, or are you just saying जैसे 70-30 हुआ मैं change करूँ?
Puneet, the point is not that we actually made decisions as per this. We did our decisions, and our thought process has also evolved over the last decade. And right now we feel this is a great way to do it. Have we actually done like this? Maybe not, because we didn't have these benchmarks to work with. So, but because we were presenting here, we wanted to model out if the approaches that we want to follow. So that's here. But largely, yes, at this point of time, if you ask me, I'm 50% in that option special situation portfolio and 50% in long investing at this current point of time.
So, Gaurav, like
Yeah.
you have taken price to book value,
Yes.
right, and not the price to earnings or price to cash flow or BL ratio. Now, price to book value, as the economic construct changes in a particular country,
Yeah.
like say if there are more service businesses and less asset-heavy businesses, then that price to book value will keep on changing.
Yeah, we agree, and that's why Siddharth tried to highlight that we are taking it on a rolling 5-year basis. We are not taking like a 100-year history or a, so on a rolling 5-year basis, in a 5-year, the construct of the economy can't change too much. So that's the reason for us not to do that. Clearly, the data is for 20 years. The first 10 years, the valuations were relatively lower, and the last 10 years, the valuations have been higher on a price to book basis. And clearly, that data in specifically highlights. So things, what we have realized is that historically, the Indian market used to get less premium, but lately, over the other emerging markets, Indian markets get higher premium.
Yeah, Gaurav, when you say switching decisions didn't happen for a longer period, you certainly mean that switches in the asset allocation didn't happen.
Yeah.
Within the asset.
Yeah.
There could have been switches like the options every month.
Yeah. So options we'll talk a lot about us.
Every component within the percentage decided, you must be switching into stocks.
Yeah. So right now we're just talking about the two assets. So the basis the construct we have done here, the switches would not have happened too often in the last few years. But within those two, we are obviously every day we are looking at stocks to buy or sell. So that's a decision that constantly happens. And similarly in options, we have spent the last 3-4 years doing a lot of tinkering around. We'll talk a bit about that subsequently.
And how do you take as it is, or is there any changes, modifications?
So again, why we refer to, we are just taking the historical data that NSE published. We are not tinkering around with that. Whatever NSE is publishing as the price to book value, that is the number that we are taking. And whatever adjustment Nifty has today, we have to take it at face value. You could question the sanctity of that data, but just to do this analysis.
And one factor which is price to book basis which the decisions are made. So you feel more factors should be there, this is good enough.
So this is one way of approaching. See, one can look at price to cash flows. One can look at other factors. There are many other factors like factor-based quantitative analysis, where factor-based they look at newer and newer factors. So one can dig down. And in our case, we just wanted to have public, reliable data points. So one is price to book value is what we have honed in on, and the other is the ratio of small cap index to Nifty, which tells us the relative valuations of the smaller companies versus the larger companies. So these are the two benchmarks that we have honed in on. Everybody are free to do the way they want to do their analysis.
In fact, there are lots of mutual funds, they call it dynamic asset allocation.
Yeah, exactly. So.
Based price to earnings, some credit to price to
So factor-based analysis, there's a tons of it. It's just that in our case, this is just a small sample size. I wouldn't say this is the best or worst.
Well,
I
I've been
don't.
following this, and my drawdown was for the last 15-20 years, never more than 20%.
Yeah.
Just out 2007 with 30% equity, because I saw the price to earning ratios crossing 25, which is called. So
Yeah.
it always helps.
So you had foresight, I didn't. So I got Roger in 2008.
Because
So
I was a what we say new five, right? So
Yeah.
I was always scared investing in the market.
So why we are talking about is that these are quantifiable rather than saying that what my gut says or what my feeling about the valuations in the market is. This is a quantifiable way of actually measuring where the market lies. And percentiles is when above 90 percentile, you know that the market can't be above this for a long period of time. Otherwise, this would not be 90 percentile. So.
Given the nature of the asset class, why would you not include options when percentile is below 10? You can use that also. In fact, you are taking more risk because of options as a risk element When,
No,
when the percentile is above 90, you are actually adding more risk to your portfolio, right?
above, you're talking about this one or this
So I
one?
have 2 points. One, why should you not do 50-50 even when it is below 10? Because the nature of options, you can earn income at that.
Yeah, that's my
Hold on. And the other one is when 90 percentile we have achieved, you are adding more risk to your client's portfolio by adding.
So first of all, we don't have clients. We are only doing it, and so we are entirely free to do what we want to do. So that is one approach. That's why we have qualified that this is one way to slice and dice. You sitting here could come up with an entirely different allocation, and you're entirely, whether you are right or wrong is entirely different. Whether I'm more right or you are more right, that really doesn't matter. What we are saying is a way of looking at things. So whether this should be 90 and 10, 95 and 5, those are subjective decisions that we can keep on debating about.
The way you look at options and the way he looks at options is different. He's not using options to leverage. He's using options to create a strategy which is producing income.
So options for us.
Options are risky, depends on the strategy.
No, I'm saying generate that income even when it is below 10 because the nature of option is that you can generate.
No. Options, again, options we'll get deeper into the aspects. We are sellers of options, not buyers of options.
Now, I can answer this question. Say, suppose you are in COVID crisis, right? Your valuations are, say, below 10%, right? And the companies or the investment universe that you track, you think there are several opportunities which in a base case could be a multiplier over 2-3 year window. You don't know whether it is going to happen next year or not. But you see there is a high chances that you can have multi-bagger returns. And in options you will create income. And if you are confident in your abilities, if you analyze, at that point of time when valuations are vehemently in your favor, would you want to be more aggressive or less aggressive? So if you are more aggressive, then whether you want to create income or you want to go for multi-bagger returns. So if I want to go to multi-bagger, I'll have 90% in equity and 10% income. This is not the point to create income. This is the point to go for aggressive investments, which is why we have done that. We have preserved the capital during. So right now, it is not a point to be very aggressive into the markets. We are conserving our drawdowns by having large allocations to income. But there would be a point to be aggressive. And when the point of that point came and we did not act, then what is the point of doing this entire exercise?
Gaurav, I have one question in that drawdown thing. SRK, my drawdown was 20% and your drawdown was higher.
Yeah.
You made so much money during that period, even after the 50% drawdown, it was much higher.
I didn't get the question. So,
Sir said my drawdown was 20% and
Okay.
your drawdown was higher.
yeah.
But during that cycle, you made that much money, that 50% itself was a great outcome for that period.
Yeah, again, different portfolios have different returns, but what I'm trying to highlight is in 2008, it's the correction in the market is not just about what amount of money your portfolio lost or the percentage the portfolio lost. It's the psychological frame of mind that got impacted. For me, it was quite dramatic. It took me some years to come out of that phase where I gained back my confidence to start investing properly again.
In the end, it's about buying low, selling high. The probability of making returns when you buy low is highest when the valuations are lower. Now,
Yeah.
it could be Great Depression, 1930 to 1940. It might take 10 years to come back. We don't know, right? The probability of making less money is higher when the valuations are at peak. Nobody can predict. It's like predicting how long I'm going to live. Right? Nobody knows. But the probability is high.
So Howard Mark really explains this very well in the way that he has put in the graphs.
I just want to add to what you said about drawdown. Ben Carlson or Michael Batley, one of them has written a blog on this. It's important how it ends, right? You may make 5x, but if your drawdown at the end is 50%, you feel miserable. Like
Yeah.
what he's saying, it affects your mental state. The guy who's made 2x and has a 10% drawdown will feel much better than somebody making 5x and having a 50%.
And also the drawdowns of the sub-portfolios within the overall portfolio. We are talking the drawdown of the overall portfolio, right? Because we want to be opportunistic. If the market crashes, we should have enough cash to invest now. But now the equity side of this portfolio might be very high.
हाँ इसको इसलिए सब मैंने खोल दिया था उसको
That is what let's start with that.
नहीं सर इसी को खोल दिया था मैंने इसलिए
So since you've given this quantifiable for the Nifty, do you have similar one for small cap Nifty ratio also?
No, so small cap, we haven't done that exercise. We just realized, so just modeling that out took so much of time because of the large amount of data. But subsequently, if you want, we can share more. We'll do that exercise for our own benefit, but not right now.
But practically, if you think of it, when we talk about when we are long equity, we are largely long small cap. Long equity means long small cap for us. We are not going to invest in largely the Nifty companies.
So by our very nature, we are full-time investors, and one of the things that we believe, and there are many other practitioners who are full-time investors out here in this audience also, is that we want to focus on the smaller caps, because that's where we feel that if we put in the effort, we meet the managements, we track what is happening in the companies. One, there is information asymmetry in the sense that we track it much closer. But in a large cap, say a Reliance or an Infosys, what edge do I have versus an JP Morgan analyst or a Citi analyst? They obviously would always know much more than me. They would have a much preferred access to the top management than me. So as a strategy, we tend to focus a lot on the smaller caps and larger caps.